Good morning. Welcome to subramani.com. One question which all of us struggle with, which everybody is being asked on a day to day basis, is how long will this last? This, not just the lockdown, general recession. When will the virus be conquered, rather? When will the vaccine be found? And one very good thing about this is none of us know the answer. So we are in very elite company that no big investor has the answer. Perhaps some good doctors have an answer, or maybe even they don't have an answer. And it's a very difficult answer. So answers can vary anything from 3 months to 3 years. So therefore, what should be your portfolio strategy during such difficult times? Well, let's put it this way. We do not know how worse can it get. We do not know how long it will remain there, and but we know what we can do about it. So what can we do about it? We can start investing, maybe in small numbers, maybe in shares which are not terribly overpriced, maybe in industries which are catering to rural India, because largely this is seen as an urban problem. It's seen as an overcrowding problem. So states which are not so densely populated, where people are more spread out, chances are the virus will take a lesser toll than in places like Mumbai, Delhi, Chennai, Pune. All these are places which are very crowded. Bangalore, it has not taken its toll, so don't try to find out why this has happened and what has happened. The data that is coming our way is also not very accurate, because the cost of classifying it as a COVID death is high. People have to then wait a long time. So they say, sir, aap isko malaria certify kar do. So we do not know. I'm not saying the data is fudged about the number of deaths, but that can't be fudged. But calling it COVID or calling it malaria or calling it respiratory failure, that is the choice which we do not know how that is being exercised. So you don't have very accurate data in terms of COVID deaths. You cannot break it up to comorbidity. Young people, when you hear of a young person dying and you find, no, he also had renal failure, he had some heart problem, you realize all that. So data is not very accurate and not very forthcoming, so we are just guessing. Given all this background, where should you invest? Well, where should you invest is a very, very clear function of how you will look at it. Suppose you think pessimistically it will take 3 years to solve the problem, and optimistically it will take 6 months to solve the problem. I think the answer lies somewhere between the two, presumably. You're perfectly all right if you start doing your SIP now, or putting money in a lump sum in a fund you choose, which is infrastructure, metals, pharma, and you think it is very reasonably well diversified amongst the sectors which are currently not doing well, and you're willing to wait for 5 years to look at it, right? That is a very important clause. Not looking at it for 5 years is very important. 2017, there were changes made in value discovery fund, and I told myself, that's fine, I'm not going to look at it till 2022. So in 2018, 19, 20, 21, if somebody gets excited saying it's doing well or not doing well, my period of review in a value fund has to be 5 years, and I'm in absolutely no hurry, right? Many of Indian fund managers would qualify as value managers, and so I would rather wait for 5 years. But many people get excited in between. So if you are the excitable types, then you have to have equity, you have to have a little bit of debt, and you have to have gold, because over the next 3-4 years, you have no clue how this will pan out. Gold always does very well when during situations of panic, and it looks like wow, because equity has done badly over the last 6 months or last 4 months. 7 years gains have been wiped out, so therefore gold may be looking better. But remember, Berkshire Hathaway has underperformed gold over a 20-year period. So it's not to say which asset class will work, which will not work. In the long run, equity will create wealth. You have to have that conviction, which means you have to be willing to hold for 5 years or 7 years, whatever it takes. I don't think you will need to hold for 7 years. I'm sure it will work in 5 years, starting now, 2020, simply because the market has come down from 42,000 to 32,000. So even assuming over a 5-year period, it goes back to 45,000, let's say, from 32,000. That's a fantastic run. Remember, it means 10% every year over the last 5 years, the next 5 years. That has to happen. So an SIP will work. So will a lump sum, right? So accept that you don't have an answer. Accept that you will then find out. If you're an advisor looking at a client, ask the client and take it from the client in writing that he will not look at it in every 15 minutes. Take from him in writing that he will look at it only after 5 years, and tell him, therefore, this is a good asset class. It's got nothing to do with him. It's got to do with his personality and his willingness to hold on for 5 years without looking at it. Then yes, equity is a good asset class. But however, if your time frame is much lesser, if it's say 2 years, 3 years, may not be a great time, simply because the market may not do anything for 2 years and then suddenly give a 60% return in 1 month and wipe out your 3 years of pain, right? Market does this. So please accept that market will do this. Also come down to understand that some temporary problems cannot have huge permanent solutions. Interest rates are down. Interest rates are likely to be down over the next 6 months if the markets don't improve, if nothing happens. That is a problem. Yes, that's a major issue. But it does not mean all your money goes into RBI bonds at 7.75. Yes, your debt portion can go into it, but remember, you're going to pay tax on that 7.75. Assuming you put into some all seasons bond fund or something like that, which is a fund of funds of I shouldn't call it fund of funds, a fund allocator fund which puts into little bit into gilt and little bit into money market instruments, and you're confident about the fund manager who is managing it. Maybe that's also not a bad place to park your money and then move it into equity. However, if you have a clear view of 5 years, maybe you put into a value fund. But if you want to put money into direct equity, maybe the sector which is currently at its worst, maybe the best sector, right? So you need to understand all that, understand your own personality before you arrive at a decision. So will people panic? Yes, people will panic. Will you panic? I don't know. You have to answer it yourself. Maybe when others panic, you buy. For example, we are expecting the listing of the debt funds of Franklin Templeton which were closed, right? Is listing an opportunity? Maybe it's an opportunity. If the NAV is 100 and you get it at 75, maybe it's a good opportunity, but you're running the risk. And somebody is willing to transfer that risk to you by taking a price, saying, okay, I am not waiting permanently. I don't mind if I get only 75 rupees to every 100 that I've invested. I'm fine. I will take that and go. Here is an opportunity. Is it luck? Is it skill? Is it the ability to sit tight? Well, it's a combination of everything. Now that it is listed, you can give a quote and you can buy. Don't ask me how much time it will take. I do not know the time frame. I'm waiting for Templeton to come out with those numbers, come out with those dates. Can you assume that the oil will continuously be at $10? No, it's already back to $30. Will it be 35? Will it be 45? Will it be 110? We do not know. We are guessing. Now, based on low oil prices, if you think therefore paint companies are good and worth buying, you may be right and you may be wrong, because the price fall in the foreign markets may be completely compensated by taxation in India. So, do you get oil at a lower price? That is the question to ask, not whether prices have fallen in the world market. Yes, world market prices have fallen, but our duty structure has been changed in such a way that it has not fallen for us. If it's not fallen for us, it's not fallen for Asian Paints. Remember that. A lot of metal shares like Vedanta have been beaten down dramatically, and so much so that they made an offer saying we will do a buyback at this price, and then the price rallied. Price was more or less there, price didn't budge, and therefore that offer is likely to be revised or withdrawn. At the price at which they offered, I don't think there will be too many takers. Not anymore. Thank you.